You're listening to Capital Topics, episode number 82. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll discuss how your behavioral biases sabotage your long-term investment plans. Enjoy! Good morning, James. How are you today?
I'm very good, François, and how are you?
I'm fine, thank you. So today we'll be tackling one of the most fascinating and perhaps the most frustrating parts of investing, which is investor psychology. We have mentioned this regularly on the podcast and in many ways throughout the years, but the biggest risks to our portfolio isn't the economy, interest rates, or price level of the markets. Most of the time, it's us. Our behavioral biases shape how we save, how we invest, and they often lead us to make decisions that feel right in the moment, but that will hurt us in the long term.
Well, that's really well said, François. And we've talked about this a lot, about doing a podcast on behavioral biases, because, again, we refer to it so often in our podcast. So, behavioral biases push investors to make really common mistakes with their investments. And that you can think of overtrading, chasing returns, or selling in a down market. I mean, those are classics. That's why it's so important to understand them and how they work. You can have the best financial plan in the world, but if you let your emotions or biases take over, that plan can fall apart really quickly. So I really would like to add, because we're publishing this podcast at the end of the year, and so it's the Christmas holidays, and there's lots of information published in the financial media, and most of it's noise, forecasting the future, how you should deploy your money. Again, if you're following pundits, you should ignore them. That's rule number one.
Exactly, James, and today we'll help our listeners develop insights to understand the most common biases and to avoid making bad investment decisions. So as you just mentioned, James, what happened in 2025 is now fact. So those results are highly likely to lead to recency bias, a bias often mentioned on this podcast, but there are many others that we would like to cover with you today.
Okay, so François, the field of behavioral economics has evolved dramatically over the past 25 years. In fact, there are too many behavioral biases to cover in this podcast, but we'll look at the most common biases that affect investors. This said, before we go ahead, François, I think it would be appropriate for our listeners for us to start with the basics.
Well, James, from my reading in investing, the term bias refers to an irrational preference or belief that clouds an investor's decision-making ability based on facts and evidence. Said differently, biases cause investors to deviate from a rational decision-making process of analyzing everything logically to a process governed by emotion, habits, and social cues. There are two types of biases, cognitive biases and emotional biases. Cognitive biases are errors in the way people process information that they are given, and emotional biases are when investors let their feelings influence their behaviors over facts.
Yes, and this isn't just theory. I mean, behavioral finance is one of the most researched areas in economics today. So the pioneers in the field were researchers Daniel Kahneman and Amos Tversky, actually not even economists, they're psychologists. And they described in a 1979 paper they published, they described how investors are risk-averse in situations of gain, but risk-prone in situation of losses. It sounds counterintuitive, but this research is the basis of what is now known as the loss aversion bias. Daniel Kahneman won a Nobel Prize in economics in 2002 for this research, and curiously, his partner Amos Tversky didn't because he had passed away, and as few people know, the Nobel Prizes only go to living people. Another researcher, an economist, Richard Thaler, won a Nobel Prize in economics recently in 2017. He furthered the field of study by developing the concepts of mental accounting and overconfidence bias. Mm-hmm. So we can add to that Robert Shiller, who won the Nobel Prize in 2013, not for this topic, but he studied herding and bubbles with Professor Gertzman, who was a recent topic on our podcasts. And then there's Professor Meyer Statman, and he's done research highlighting how emotions and social factors affect investment decisions.
Yeah. Unlike traditional finance theories like the efficient market hypothesis and the modern portfolio theory, which assume that investors are rational decision makers, this research recognizes that emotion, biases, and mental shortcuts often lead to irrational investment behavior.
That's exactly right, François. And recent studies show that biases continue to evolve. And this is due to investors' over-reliance now on the new artificial intelligence technology that's available, and then the tech platforms that they're trading on. So these new studies mentioned that technological innovation, and remember the COVID-19 pandemic, we were all locked in, and then the rising level of retail investor activity that really intensified. Well, this has created behavioral distortions in the markets.
And some behavioral finance helps us understand that investors aren't robots, they're humans, and that means they're vulnerable to fear, greed, and social pressure, which explains why we often act against our own best interests.
François, I think now we can take a closer look at some of the main biases to show how they negatively affect investment decisions and damage investors' long-term financial situation.
Sure, so let's get right into it, and let's start with the recency bias. I know, James, that you love that one.
Yes, I do. It's one of my favorites, and it's got many different layers to it. So, but technically, at its basis, the recency bias is a cognitive tendency to give more importance to recent events or information. This in turn leads investors to assume that the recent trend is more likely to continue in the future, sort of ride the wave, if you will. But to me, François, recency bias is much more than assuming a trend will continue.
Yes, and it steers investor into taking short-term decisions that may negatively affect their long-term financial plans.
So, yes, totally, François. Over the course of my career, I've seen many investors typically more comfortable taking risks in an up market, particularly after many successive positive returns in capital markets, because they expect the strong performance to continue. And then they shy away from taking risks after a market correction or a bear market, as they expect markets to continue to drop. So it's sort of the old falling knife analogy. I don't want to catch a falling knife, so I'm going to wait till I pick the bottom, right? Which is impossible.
It's a very common behavior. I remember back in 2008, 2009, a lot of people did not believe that markets would recover, and they stayed on the sidelines, and look at where we are now. This bias is like not wanting to go into the ocean after watching the movie Jaws, despite the fact that shark attacks are very rare.
Yeah, well, that's a good analogy. Another bias that I see a lot of, François, is the overconfidence bias. And this is the tendency for a person to overestimate their investing capabilities. And these investors overestimate their understanding of financial markets or specific investments. They become overconfident in a single bet stock that's done really well, so they think they've got great stock picking skill. So they believe that because they picked that winning stock, they can do it again. And it's the same with market timing. You're going to guess the right time to get out and the right time to get in.
Yes, the overconfidence bias tricks the brain in believing that it's possible to consistently beat the market, but as our listeners know, it's very difficult to do so. For the average investor, overconfidence most often leads to poor portfolio performance because of excessive trading and underestimating the risk that they are taking in their portfolios. And recent research mentions that a source of this overconfidence in today's world is the wealth of information available online, which creates an illusion of understanding. So, James, let's now look at the loss aversion bias.
Well, François, this bias was first introduced, as I mentioned earlier, by Daniel Kahneman and Amos Tversky in their paper in 1979. And according to their research, and I quote, "The torment of a loss can be psychologically twice as powerful as an equivalent gain." So psychologically, investors have a tendency to prioritize avoiding losses over earning gains. And I've seen this behavior with clients over the years.
Yes, in Kahneman and Tversky, research showed this bias is hardwired. It's not just about money, it's about emotion, and these emotions result in investor being overly conservative. In down markets, they stay on the sidelines and avoid buying stocks, or they outright sell their stock position to protect their portfolio from further losses. They then miss out on the gains when stock rebound. A good example of this was highlighted by the independent financial research company Dalbar in their 2023 quantitative analysis of investor behavior report. And in that report covering the year 2022, which was one of the worst years for the S&P 500 index, they measured that the average equity investor lost 21.2% compared to 18.1% for the S&P 500 index. The negative gap of 3.1% against investor was in part attributed to the loss aversion bias.
Well, François, it's a good example, and it's a reminder that if you stay invested, you will capture all the returns markets have to offer when they eventually recover. But if you panic and you sell, you have to guess when to get back in. And that's the thing most investors forget. It's two decisions, right? When to sell, you may get it right, but when are you going to get back in? And you're probably going to have a little bit of overconfidence and thinking you can guess the right time to get back in. So it's two decisions. The risk here is locking in permanent losses that compound over the long term.
Indeed, James. And the next bias we would like to cover is the herding bias.
Well, that's another big one, François. This is the cognitive bias deeply rooted in our human instinct. And at one point in the evolution of mankind, it was all about survival. You know, we had to hunt for our food, and we were competing with predators that could threaten our existence. So as human beings, though, we're sort of wired for this fight or flight kind of reaction. And in finance, it's more about fear and greed. So investors make investment decisions based on what others are doing without doing their proper due diligence and research. This bias can cause investors into panic selling or taking unnecessary risks in their portfolios due to the fear of missing out.
Oh yeah, James, the famous FOMO, fear missing out. The greed that drives people into buying the latest hot stocks, market trend, and often into an overvalued asset. This bias is at the root of financial bubbles. The dot-com bubble is a great example of herd mentality. Investors bought dot-com company because everyone else was buying them, but many of those companies did not have a financially sound business model.
Again, François, this is a great example, and there are many others. Think of the meme stocks during the pandemic and the cannabis stocks that came out a couple of years ago. We can also mention the Bitcoin frenzy and the trading around it. What investors need to do is question the rationale before making their investment decision. They could also remind themselves of Warren Buffett's famous saying, "Be fearful when others are greedy and greedy when others are fearful."
Yeah, that's a great quote, and I could not agree more. The next bias to cover is the confirmation bias.
Well, that bias is when an investor will only look for evidence that supports their view. So they bought an investment, this was the thesis, they believe in it, and then they just look to information that's going to say, yeah, your decision was right.
Yes, due to this cognitive bias, investors are inclined to search, favor, and interpret information that supports their opinion about an investment. They can even wrongly interpret some information just to confirm their belief. These investors can also reject information that challenge their belief.
I would add, François, that now with algorithms embedded in social media platforms, it really exacerbates this bias because these algorithms push out content similar to what people have recently searched for. So it's like a self-fulfilling prophecy loop that they're falling prey to.
Correct. And the risk here is that this bias will lead investors to have portfolio concentration in a particular stock or sector, therefore making them vulnerable to a downturn in that stock or specific sector. Their views on the market conditions could also be distorted because they focus on the opinions of a few experts, but they ignore those of others.
The last bias we'll discuss today, François, is the anchoring bias. And this is a cognitive bias where an investor becomes overly attached to the first piece of information they encounter during their decision-making process. So this information then serves as an anchor, a reference point of sorts, and that distorts subsequent judgments or prevents the objective evaluation of new data.
Yes, and that's a trap that many investors fall for, particularly when they trade individual stocks. An example of this is when someone buys a stock, let's say at $20, and refuses to sell below that price, even if the outlook and fundamentals of the company have changed negatively. Another anchoring investor bias involves holding to a stock that has dropped in value and refusing to sell until it reaches or comes back to an historical all-time high.
Well, that's classic, right? Again, I would add, François, that anchoring distorts an investor's rational decision-making capabilities.
So, James, we've covered several biases here. What do you think are the lessons for our listeners?
Well, like I said at the beginning, François, this is a period of the year where investors are vulnerable with all of the noise in the financial media. So I think that this is a reminder that investing is as much about psychology as it is about numbers. And I have a great quote from our friend Jason Zweig from the Wall Street Journal, who once said to someone who asked what he did for a living, and I quote, "I try to figure out why smart people do stupid things with their money." And this, I believe, François, is where advisors add a lot of value for their clients. Advisors aren't just portfolio managers, we're behavioral coaches. So I would word things a little differently from Jason. I would say we help smart people avoid making costly mistakes with their money.
Yeah, I agree, James. And research proves the value of an advisor. Vanguard's Advisors Alpha study estimated that behavioral coaching adds up to 2% in net returns annually. We will add a link to our previous blog that covered the Vanguard research. And there's also a Morningstar research called the Morningstar Value of Advice report that highlights that the greatest benefits of advice is behavioral, not technical. Their research states, and I quote, "Behavioral coaching is the single most impactful thing an investor can do, adding on average 150 basis points." They continue and say, and I quote again, "Emotions can be our own worst enemy, especially when the markets are volatile, and guidance from a behavioral coach can save us from panic selling and abandoning long-term financial plans."
Okay, so I would end this, François, by saying that advisors really act as guardrails for their clients. We stop our clients from turning temporary emotions into permanent mistakes. And again, the takeaway is clear. Markets will always be unpredictable, and biases will always be a factor for investors. But with awareness, discipline, and the support of trusted advisor, investors can avoid the traps that sabotage long-term success. And like you said in the intro, François, the biggest risk isn't the market, it's us. And so mastering our own behavior is the ultimate edge in investing.
All right, so we'll conclude on this. Thank you, James, for sharing your thoughts and expertise again today.
My pleasure, François.
Okay, just before we conclude, I'd like to wish our listeners a very happy holiday season. And on that note, that's it for episode number 82 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you'd like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on January 21st. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. Thank you. See you soon.